Hi friends, welcome to A to Z Learning channel. Today in this video, we'll talk about how to assess banks. Banking stocks are a critical part of NIFTY and any other stock exchange. Whether you are a retail investor who's investing via mutual funds or index funds or direct stock, it is impossible that you won't have any exposure to banks. Whatever is your portfolio, whether you are directly picking up stock or via mutual funds and index fund, you are bound to have some exposure, and most of the time you'll have significant exposure to banking stocks. It is because when you look at Nifty stocks, banks all put together roughly represent 42% of the Nifty stocks. So 42% of the weight in the Nifty stock is due to banking stocks. Similarly, Nifty Bank is also a very popular index where a lot of people trade, and that is entirely formed of all the banking stocks. So I think it is fair to say that if you have any investment in the equity market, you are bound to have exposure to banking stock. So then the question comes that how do you assess which bank is strong, which bank is weak? What are the key matrices that one should look at to fundamentally analyze and review whether banking companies, banking stocks are worthy investment or not? So in this video, we will share with you a simple list of 5 matrices that if you can understand and track for all your banking stocks, then you'll be able to make an informed choice whether that bank has got strength or weakness. So it's going to be a very important video. So without any further delay, we'll start our video. As I said, first of all, let's understand what are those key matrices that one should keep in mind, one should understand while assessing banking stocks. It has come on your screen, those 5 matrices that we are going to be talking about today. This is all about, first of all, please note that this is all about fundamental strength of the banks. It is not at all dealing with the what is the stock price, what is the market sensitivity. It is also not dealing with the technical charts like what is the moving day average or daily, 20 days, 50 days. It is not talking about the technical indicators. It is purely looking at the fundamental strengths of the bank, fundamental numbers of the banks, and on that basis which bank comes out stands strong, and how to kind of have a thumb rule which help you understand whether bank has got strength or weakness. So the 5 matrices that I personally believe in are net interest margin, return on assets, CASA ratio, capital adequacy ratio, and the fifth one is the net NPA. Now we'll talk about each of this metric in detail. So let's first pick up the first metric, which is net interest margin. What is the business of a bank? Bank gets money from its depositors where they pay interest to their depositors. So that is the interest income that they are spending. At the same time, whatever money they gather, they get from the depositor, they use that money to lend to people who need money for investment, buying assets, things like that. That's where they earn interest. So net interest margin is basically nothing but the difference between interest earned by the bank subtracted by interest spent by the bank. So what is the net interest margin? By nature, if your interest earning is more than the interest spending, then your net interest margin will be positive. And if bank has a negative net interest margin, means that bank is not making money, and that can't be good. Typically in Indian context, the good level of net interest margin is basically about 3%. So if bank's net interest margin is more than 3%, that is considered a good bank. the bank with strength. Hope it makes sense. Let's move to the second metric, which is return on assets. This basically shows how profitable banks' assets are in generating revenue. Banks have got all those kind of cash that comes, they use it to lend, to make investment, and then they earn interest income. So how good bank is in terms of using those assets to generate revenue. Typically, a good level is considered that if return on asset is more than 1% for a bank, it is considered good. Anything that is less than 1% on return on asset means bank is not properly utilizing their assets to generate revenue. Third one is the CASA ratio. CASA ratio stands for current account and saving account ratio. This basically means that what is the proportion of bank's deposit from current accounts that they offer to their customer and the saving account deposit that they offer to their customer. Higher the CASA ratio, better it is, because usually banks pay very nominal interest on the current account and saving accounts. If bank is able to generate more deposits in current account form and saving account form, that means their cost of raising money, cost of getting money is very, very low, which is always good for a bank. Typically, it is seen that if CASA ratio is 35% or higher, then it is considered good for a bank. Now let's move to the fourth one, which is the capital adequacy ratio. What is this ratio? This ratio basically tells banks' capital in relation to risk-weighted assets and current liabilities. So what this basically shows that if there was a bank's urgency that deposit wanted their money back and all that, they'll be able to meet those commitments. So capital adequacy ratio provides an indication that bank has got decent enough capital to fulfill the demand from its depositors. Typical good level is considered if the capital adequacy ratio is maintained above 10%. To be safer side, if you keep it 12% or higher, then the bank is in a strong position. The last metric that we will look at is the net NPA. NPA stands for non-performing assets. The nature of the business in a bank is such that they grant loan, and by I guess it's common, it is normal for banks to see some loans that go bad, where where their kind of creditors are not able to pay them back their loan, or they delay the repayment. So those loans are considered as bad. And net non-performing asset basically means the portion of the bad loan which bank has not yet provided for in the books. Usually when a loan goes bad, say there was loan of 10,000 crore which went bad, banks usually start to provide for it. But they normally provide for say 7,000 crore, 8,000 crore, depending on how bad it is. But they never provide for 100%. So the part which is not provided for in the P&L is called net non-performing asset. Typically, if a bank has got net NPA of less than 1%, it is considered very good. Bank is considered strong. I hope simple explanation of these 5 matrices that we are going to be looking at in assessing bank. The explanation has been simple to understand, simple to follow for you. Please do let us know through the comments if you have any question on this. If you think you have any better suggestion on any of these metrics, again, let us know through the comments. And if you're really liking our content, then please press the like button on our video and also share with your friends who may be interested in a similar topic. Now let's move to the next section, where what we would help you is basically apply these 5 matrices on all the famous banks in India to help you understand which banks stand in strong position and which banks stand in weak positions. So it may be eye opener for you, because on certain matrices, certain banks, you may be thinking they are strong, but you may realize no, they are not as strong as you generally think. Or some bank you may think are weak in perception, but applying these fundamental matrices, they look strong. So all that we will share uh, now. So let's start with that. As I said that, let's now look at the bank's fundamental strength. And here, as the information has come on your screen on this table, we have looked at 10 famous banks in India. So these banks are Kotak Bank, HDFC Bank, IndusInd Bank, Yes Bank, Bandhan Bank, RBL Bank, IDFC First Bank, Axis Bank, SBI Bank, and ICICI Bank. So we have picked up all the banks, the main banks for, for comparison, and we have applied on the top, as you can see, these five matrices. So first column is for net interest margin, NIM. Second is ROA, which is return on assets. Third one is the CASA, which is current account and saving account deposit ratio. Then the capital adequacy ratio, which is CAR. And the last column is net NPA percentage, which is net non-performing asset. The first row where I've captured the good level. So for each metric, I've captured what is the kind of good level for that particular metrics. For example, when I'm saying in the first column net interest margin, I'm saying it must be more than 3%. So if this number is more than 3% for the banks, then it is considered good. Similarly, return on asset, it must be more than 1%. CASA must be more than 35%. CAR ratio must be more than 12%, and net NPA must be less than 1%. So these are the kind of good level uh, to assess whether bank is in a strong position or not. And now you will see that I've color coded this table. So first of all, I'll draw out Kotak Bank, which is the first line. Kotak Bank has got NIM, which is net interest margin of 3.96, which is more than 3%, therefore good, strong bank. Return on asset 1.93, which is higher than 1%. Again, thumbs up, good position, strong bank. CASA ratio, which must be above 35%. Kotak has got 56%, and they have got the highest CASA ratio in the entire banking sector. So again, big thumbs up, very good. Capital adequacy ratio must be more than 12%. They have got 18%. Again, big thumbs up. Net NPA must be less than 1%. Their NPA, net NPA is 0.71. Again, big thumbs up. So across all the five metrics, Kotak Bank is getting big thumbs up. So it's all green. Same way, next line HDFC Bank, absolutely no problem, no red flag there. All the parameters, they may not be as strong as Kotak Bank, but they are still higher than all the good level that we have described here. IndusInd Bank, again, all no red flag, absolutely no flag. All the measures are better than the good level that we have described here. Then comes the fourth line, which is Yes Bank. This is where the trick starts. This is where the trouble starts. As we all know, the bank is struggling. And this fundamental assessment confirms that whether you look at net interest margin, ROA, CASA, capital adequacy ratio, or net NPA, they are completely red across all these matrices. Net interest margin, we are saying, must be more than 3%. They have got 2.6. Return on asset is negative for them, so can't be good. CASA, where we expect it to be more than 35%, they are 27%, so again not good. Capital adequacy ratio must be more than 12%, they have got only 9%, again not good. Net NPA must be less than 1%, there is 5%, which is again not good. So Yes Bank across all these matrices, fundamental basis is a complete red flag, which is again hopefully not a surprise for you. Bandhan Bank, against all parameter, big thumbs up, no issue. In fact, their net interest margin is best in the industry, 6.89%. And that is also nature of their business because they provide micro loan and micro loans usually fetch better interest income. Their CASA ratio is also 37%. So they are able to generate a lot of their cash through current account and saving account. And their net NPA is only 0.58. So again, Bandhan Bank, big plus. Then comes the set of banks, RBL, IDFC, Axis Bank, SBI Bank, and ICICI Bank. They all have got between 2 to 3 red flags. So for example, RBL Bank, while it's good on net interest margin, no issue, good on not good on return on assets, it's only 0.56. CASA ratio is only 30, and net NPA is 2%, whereas it must be below 1%. IDFC first, while good on the net interest margin, loss making, so return on asset is negative. CASA only 32%, so that's not good. But their net NPA is only 0.94, which is good. Axis Bank, net interest margin of only 2.77. SBI Bank same 2.59. ICICI Bank again same 2.91. So all these three banks have got poor or red flag on net interest margin, same way red flag on return on assets, and red flag on the net NPA. So overall, you would kind of feel that we have got in the list of these 10 banks, Yes Bank is a complete red flag across all measures. Then there are 5 banks, RBL, IDFC First Bank, Axis Bank, SBI Bank, and ICICI Bank are again have got 3 out of 5 or 2 to 3 red flags out of 5 measures that we have used. But 4 banks that stand out really strong across all these 5 measures are Kotak Bank, HDFC Bank, IndusInd Bank, and Bandhan Bank. All other banks have got some or other problem. Yes Bank completely a problem child, but all other banks also has got problem. But these 4 banks, Kotak, HDFC, IndusInd, and Bandhan, stands very strong, stands very strengthful. And just to kind of let you know, this analysis is based on the audited numbers as of March 2020. We have got the latest quarterly results, but those are not audited numbers, therefore we have not used those numbers. We'll refresh this next year, 31st March, or at the end of this year, fiscal year, which is 31st March 2021. So hopefully this simple application of 5 matrices on all the main banks has helped you assess which banks you want to have equity exposure to. Please do let us know through the comments if you really like our content. And if you have not subscribed our channel, we would again urge you to please subscribe our channel A to Z Learning, become part of our viewers family, because our viewers family help us drive the topics on which we make the new videos. So please become part of our viewers family and suggest and help us kind of drive the agenda for the future videos. Thank you so much and good luck with the investing.